Welcome back to Economic Hero, where we break down the complexities of our economy and make sense of the financial world. Today, we are diving into a critical issue that could shape the future of our economy: stagflation. It's a term you may have heard before, but do you know what it really means and how it can affect you? Stagflation, an economic phenomenon where we experience stagnant growth coupled with high inflation. It's a double-edged sword that can leave economies reeling and policymakers scratching their heads. Imagine an economy where prices keep rising, but growth is at a standstill and unemployment is soaring. It's a nightmare scenario for any central bank, and it's something that we've seen before. In the late 1970s and early 1980s, the United States faced severe stagflation. Unemployment reached 10%, and interest rates soared to a staggering 15%. The usual belief is that high unemployment should lead to lower inflation and vice versa. However, stagflation defies this logic, presenting both high unemployment and high inflation simultaneously. Wall Street and the Federal Reserve often get their predictions wrong, and their models frequently fail to account for the complexities of the real world. Their models didn't see stagflation coming back then, and they might not see it coming now. Currently, we're seeing early signs of a similar situation. Despite what some experts might say, inflation is real and persistent. It's sticking around and could lead us into another stagflationary episode. This is particularly troubling given the state of the stock market, which is currently riding high on optimism. Jim Rickards, a well-known economist, has recently sounded the alarm, predicting that the U.S. might be on the brink of stagflation. If his prediction holds true, the consequences could be disastrous for a stock market that's already at unprecedented highs. Investors are currently optimistic, but the underlying economic reality threatens to drag them into a vortex of financial turmoil. Stagflation erodes purchasing power, squeezes corporate profits, and leaves policymakers with very few viable options. Inflation eats away at real returns while economic growth grinds to a halt. If this scenario plays out, the stock market, which is now basking in record peaks, could face a severe correction. Investor confidence, which is currently buoyed by record highs, could shatter, leading to a massive sell-off that would reverberate across the financial landscape. Rickards' warning serves as a stark reminder that today's market exuberance is underpinned by fragile economic fundamentals. The Federal Reserve's current stance is a perfect example of the delicate balance they must maintain. On one hand, they need to control inflation, and on the other hand, they need to support economic growth. However, inflation has remained stubbornly high, hovering between 3% and 3.7% since June 2023, well above the Fed's 2% target. Despite keeping interest rates at 5.5%, inflation shows no signs of abating. The persistent inflationary pressure poses a significant dilemma for the Federal Reserve. Cutting rates in an environment where inflation remains high could exacerbate the problem, undermining the Fed's credibility and potentially sparking further price surges. On the flip side, maintaining or even increasing rates to combat inflation could stifle economic growth and dampen investor confidence. As the market continues to soar on the expectation of rate cuts, the underlying inflationary woes suggest a rocky path ahead. The central question remains: will the Fed dare to cut rates in the face of stubborn inflation, risking further economic destabilization? In July 2023, the Fed stopped hiking rates, opting to hold steady for the time being. But they are not even close to a rate cut, contrary to what some market pundits might say. Wall Street has been talking about a Fed pivot for over 2 years now, starting in the summer of 2022. Back then, the Fed had just begun raising interest rates from zero, and the market expected a pivot towards easing monetary policy by early 2023. However, here we are in mid-2024, and those expectations have yet to materialize. The stock market's relentless climb since bottoming out in October 2022 has been fueled by these expectations. In November 2021, with interest rates at zero, the market reached unprecedented highs. Fast forward to May 2024, with interest rates at 5.5%, and the market has surpassed those peaks. This relentless upward trajectory, despite a significantly higher risk premium, signals a market driven more by hope than by reality. The disconnect between the market's expectations and the Fed's actual actions underscores the potential for a sharp correction. Investors seem to disregard the possibility that the Fed, grappling with persistent inflation, may not pivot as anticipated. This disconnect creates a precarious situation, making the case for a significant market correction very compelling. Rickard's warnings resonate strongly in this context. The market's unfounded optimism could lead to a significant downturn if the expected Fed pivot does not materialize. Investors must heed these warnings and prepare for a potential reversal that could catch many off guard. Inflation peaked in June 2022 at 9.1%, the highest since the early 1980s. By June 2023, it had come down to 3%, but it's important to remember that this was still above the Fed's target. Since the onset of COVID-19, the Federal Reserve massively increased the money supply through stimulus measures. Although they ceased these actions in 2022, the U.S. government has continued to borrow at record rates, causing federal debt to skyrocket from $29.5 trillion in May 2023 to $34.5 trillion today. This $5 trillion increase has significant implications. After consumers pay their bills and fulfill their needs, this money ultimately flows into the coffers of banks and large businesses, which then channel it into the stock market. This influx of capital explains the market's remarkable surge. However, this financial environment has left the U.S. consumer stretched to their limits, teetering on the brink of collapse. The echoes of the 2008 financial crisis, triggered by a collapse in subprime mortgages, serve as a stark warning. With consumers grappling with rising interest rates, the pressure mounts. This scenario could lead to increased government funding to support struggling households, perpetuating high inflation and steering the economy towards stagflation. Rickard's warnings about stagflation come into sharp focus here. The continuous flow of government money into the stock market, despite underlying economic strains, creates a facade of prosperity. Yet, if consumer financial stability falters, it could trigger a broader economic crisis. The delicate balance between inflation control and economic growth is at risk, making the current market euphoria a potential precursor to a severe downturn. Investors must remain vigilant and prepare for the possibility that the seemingly unstoppable market rise could end abruptly, with significant consequences for the broader economy. The U.S. stock market may be at an all-time high, but the underlying fundamentals are precarious. Many companies are trading at exorbitant multiples, with stock prices rising even as their revenues decline. This disconnect between stock valuations and economic reality is a clear signal of potential trouble ahead. Rickard's warning should not be dismissed. It is a call for caution. Rather than plunging headfirst into the market, investors would be wise to adopt a more conservative approach. The risk of a significant market correction later in 2024 looms large, especially if anticipated market shifts fail to materialize. Exiting the market now, while prices are high, could be a prudent move to avoid potential losses when the bubble bursts. In this uncertain economic climate, caution is not just advisable but necessary to protect investments from a potential crash driven by unrealistic market expectations and fragile economic conditions. Thank you for tuning into Economic Hero. If you found this video helpful, make sure to hit the like button and subscribe for more insightful content. Stay informed, stay prepared, and stay ahead of the curve.